Modi ji and re-elected it for a historic third term under his leadership. With the vision of Viksit Bharat at 2047, Honorable Finance Minister has covered the several policy and administrative changes or reform in her budget speech. Significant tax-related changes have been announced by Honorable Finance Minister in the Union Budget 2024-25 to bring greater awareness about the new tax proposal and their impact on MSMEs, startups, and other industries, and to provide clarification across the table of to the stakeholders. We at ISFA organized today's session. We at ISFA always promote the government initiatives and spread the awareness about the government policies, schemes, and decisions and new updates. ISFA is the voice of Indian small business and franchise industry. ISFA would continue to work towards the betterment of the industry at all levels. We aim to support the entrepreneurs across the country to emerge as a global entrepreneurs. We helping startups, MSMEs firm to grow or ensuring a smooth working. ISFA is committed to provide every possible help to every firm and person associated with it. I would also extend my gratitude to our knowledge partner, Shinewing India, for accepting our request and nominate their experts for sharing in-depth details on budgetary changes in taxation. SW India is a member firm of SW International, one of the most influential and integrated professional services organization in the globe with diversified capabilities. SW is the fast expanding professional services network to experts in key locations around the world. As the only extensive international network with deep roots in the Asia Pacific. SW is the gateway between the world's largest economies and the rest of the globe. Before we begin, I would also like to extend my heartfelt gratitude to Franchise India Group, whose support has made this session possible. Their dedication to promoting entrepreneurship deserves the recognition. I encourage you to actively engage and ask as many as questions to our experts and take the advantage of this platform. Without taking more time, I request to our eminent speaker, please start the session with their brief introduction. Now, over to Ankur Gupta sir, who is the partner in SW India and leading the indirect tax practice there. Ankurji, please.
Right. Thanks, Akshat. And we welcome you all. Thank you for joining this session and hope we would be able to add some value addition to whatever you have read or heard about this year's budget. So, starting off with this presentation, we'll start off with the indirect taxes, the proposals that have been taken up in this budget. So, and Deepak Awasthi, who is also a senior manager in SW India, would be covering the direct tax part of this budget speech. So, starting off with the amendments that have been proposed under GST. So, brief about all the indirect tax changes that have been done in this budget. So, be it customs, be it GST, those are primarily focused to boost India's manufacturing capabilities, enhancing their export performance, achieve a positive position in the near future, reducing import dependency, and making a footprint at the global supply chain level. So, with this vision in mind, which has been in the previous government's tenure as well, so we will definitely see a much stronger foothold in the global supply chain going forward. So, moving on with the changes under GST, Section 9 has been amended to include extra neutral alcohol used in manufacturing of alcoholic liquor for human consumption. So that has been kept outside the purview of GST, and now states can levy taxes as per their wills and provisions. Second amendment is pertaining to there are specific provisions that have been added to GST legislation to empower the government to address issues of non-levy or short levy of tax resulting from common trade practice. Now, this provision is similar to Section 11C of Central Excise Law and would be very crucial and important to resolve sector-specific issues and disputes. So we'll have to see how it will be implemented at the ground. But the intent of the government is to have a power in hand to forego these short levies. Next is pertaining amendments pertaining to Section 16. So the amendments in Section 16 aims to standardize the timelines for claiming ITC for financial year 2017-18 to 2020-21. And the amendment says that if the returns have been filed up to 30th November 2021, then these would not be treated as a time barred credit, and credit can be availed by the taxpayers basis the returns filed up to this date. Now, this restriction was challenged by various high courts and is pending for review at Supreme Court. Recently, Madras High Court also upheld the constitutional validity of this section, but as the in last year's budget, the due date to avail the credit has been shifted from September to November. The Madras High Court held that this benefit should also be available for the previous periods as well. So, combining the court's ruling and the 53rd GST Council's recommendation, it has been incorporated into the Act. And now the deadline for claiming ITC for past years has been extended. And this should definitely reduce the litigations and with the amnesty scheme, which I'll cover in the later part, will clear the backlogs and the litigation on this particular topic. Another important point on this is even so, for example, if somebody has paid taxes or has reversed the ITC earlier, no refund would be granted on this provision. Next is with respect to changes under Section 31. So GST Council in its 53rd GST Council meeting recommended to clarify, and then a clarificatory circular was also issued 211 dated 20th 26 June, that in case of supplies received from unregistered suppliers where tax has to be paid under reverse charge, the invoice, since invoice has to be issued by the recipient only, the relevant financial year for calculation of time limit to availment of credit would be the period in which that self invoice has been raised. Now, to take an example, for example, if we have availed a service in 2017-18, which was subject to reverse charge from an unregistered supplier, and if I'm paying that tax in 2024-25, then basis this amendment, basis this section, I am eligible to take credit up till 30th November 2025, which is the due date to avail credit for the entire year FY 24-25. So this provides clarification, and it puts rest to the all the litigations and contestation by GST authorities that since the credit pertains to previous year, the timelines would also be determined from the previous year. So this again is something where a welcome change that has been brought for the ease of business. Next is pertaining to Section 70. So as GST authorities have the power to issue summon for any proceedings, earlier when the summon was issued, the relevant person was only required to be or was required to be appeared before the GST authorities. The representation by a consultant or any authorized representative was not required, was not allowed to be that they can appear. With this amendment, a discretion, while the words authorized representative has been added, however, the discretion still rests with the GST officer whether to allow or not. So we really have to see whether at the ground, once this act is implemented, these changes or these benefits would be allowed by the GST officers. Next is with respect to 73, 74 and introduction of 74A. So this budget restricts restricts the applicability of section 73, 74, which currently handles demand and recovery for fraud and non-fraud case respectively. These sections will only be applicable for cases up to FY 23-24. The aim for for omitting the section and introducing the section 74A is to remove the previously complex and contentious timeline for show cause notices, orders, while keeping the distinction between fraud and non-fraud cases. As per the new section 74A, a unified period of 42 months for issuing show cause notice and 18 months, including a 6 months extension for issuing orders, has been proposed with different penalties to differentiate between fraud and non-fraud cases. This aims to simplify the procedures but may pose challenges for honest taxpayers as the period of non-fraud cases will also is also getting extended to 3 to 5 years, which earlier was only 18 months. So there is a huge gap, huge difference in the time period. So that the time limit available to the officers to close the proceedings for going forward is too huge for any SSCs. Another is insertion of new section 128A. So this section 128A is primarily an amnesty scheme which provides a waiver of interest and penalty for demand notices issued under section 73 of CGST. This would be applicable for the period 1718 to FY 1920. The cases which can apply or which would be covered under this amnesty scheme would be where show cause notice has been issued, but the adjudication is pending. Second, where show cause notice is issued and the order has also been issued, but no appeal has been filed. Third would be where appeal has been filed and order also has been passed by the appellate authority, or if the appeal has been filed before the revisional authority, order has been passed by the revisional authority. So in this scenario, all the cases that are pertaining to issue section 73 can be clubbed or can be used for this particular amnesty scheme, and benefit can be availed. Now, the benefit would not be available if in case the appeal has not been withdrawn within the stipulated date. So you and a confirmation has is to be provided that no further appeal would be made by the SSC with respect to whatever benefit or payment has been made against this amnesty scheme. So the detailed guidelines on these are yet to be issued because as of now, based on the finance bill and the clarification and the TRU circulars, it has not been clarified on cases where taxpayer is in receipt of a notice or a order involving multiple issues. So if he wants to settle only a single issue rather than all the issues, whether the amnesty, he can still go for amnesty. Secondly, if an order has been passed for multiple years, if he wants to settle or go for amnesty scheme only for a particular year, whether he can still do so. So those are the questions still on the ground, but so we'll have to see the clarifications once the detailed guidelines are out. So these are primary changes that have been under the GST Act. Moving on to the customs side. Under customs, the first change that has been done is a game-changing move by the central government by shifting, by introducing the word proof of origin. So earlier, the requirement was to submit a certificate of origin. Now the government has mentioned and has done amendment in section 28A, which requires now instead of a certificate, a proof of origin. For claiming preferential rate of duty under customs, acceptance of proof of origin would be required instead of certificate of origin. Now, this amendment would align with customs provision to allow importers to claim preferential rate of duty, either certificate issued by the authorities or by self-certification. This is a global phenomena, and this is something that is applicable in UK and other European countries as well. So now, since India is focusing on new FTAs, so these changes would further enhance India's thought process, how world sees India's documentation process. Second amendment is with respect to warehousing provisions, which are amended to empower the government to notify the activities that are not to be considered as a manufacturing process and other operations in warehouse in relation to specified class of goods. The third is with respect to retrospective exemption proposed on the imports made by SEZ. That so the cess has been exempted from 1st of July. That is a retrospective amendment. Secondly, the time period for to re-import the goods under warranty replacement or claim exemption from custom duty in specified cases is extended from 3 to 5 years, further extendable to 2 years. The time period to re-export the goods for maintenance, repair, overall in specified cases is extended from 6 months to 1 year. Now, in this customs tariff, what the primary changes that have been done are, if I talk in brief, so gold, silver bars, mobile phones, critical minerals have become cheaper, whereas solar glass, laboratory chemicals, PVC flex films have become costlier. Uh, Along with this, the government has also undertaken review of 188 exemption or concessional notification, in which 30 exemption concessional notifications are being extended to 31st March 2029. 126 exemption or concessional rates are being continued till 31st March 2026. 28 exemptions or concessional rates are being lapsed on their end date, which is 30th September 2024. And in 4 exemption notifications, the end dates are being removed. So all these changes are aligned to improve India's capability, domestic capabilities. The intent is to discourage import of finished goods, but import the parts or raw material and build the capability to manufacture them in India with number of PLI scheme that has already been launched. So primarily the focus is to make India's footprint much stronger in the manufacturing capabilities as well. So that's it from my side on the indirect taxes. We definitely can take questions at the end of the session. Over to you, Deepak, for the direct tax part.
So thank you, Ankur. I'll start with my introduction. So this is Deepak Awasthi, and I'm manager at Shanwing India, responsible for direct as well as international taxation. So I'll start with the equalization levy. Why it was introduced and why it has been removed now. So the purpose of introduction of this equalization 2.0 was that it was introduced on the e-commerce supplier services for the e-commerce operators. So it was introduced by the Finance Act 2020, and all the receipts under this equalization levy 2.0, it was to be received at the rate of 2% of the amount that has been received. But now there has been some ambiguity in the provisions and the collection of equalization levy. So now through the Finance Act 2024, it has been decided that it will be discontinued. And if I talk about the main intent behind removing this is because of the steps that the India needs to take for implementation of BEPS Pillar 1 and Pillar 2 in India, because there is a condition that no country can take unilateral measures to implement any these kind of duties. So that is the reason the equalization levy 2.0 has now been deleted, and this will no longer be applicable. And this is effective from 1st of August 2024. So I'll move to the next amendment. So the changes in budget are incomplete when we don't discuss about the change in tax rates for individuals and as well as for the companies. If I talk about the change in tax rate for domestic companies, there is no tax rate change that has taken place in the budget. While there is a change in tax rate of foreign companies, earlier it was 40%. Now it has been reduced from 40% to 35%. And when we talk about the taxation of individual and HUF, the house property, the Hindu undivided family, there has been no change in the old regime of taxation. Absolutely no change has been done in that part. But the new regime of taxation, it has been made more effective, more lucrative to the taxpayers. The slab rate has been changed. Earlier, there was only 5 slabs are available, but now within those 5 slabs, they have changed the rate, and it has provided some relief to the taxpayers because there will be reduction in their taxes. So this scheme has now been made more beneficial for the individual taxpayers. So if I talk about the standard deduction, it is available now at rupees 75,000, while earlier it was available at 50,000. But this uh, standard deduction of rupees 75,000 is available only if you have opted for the new regime of taxation. While if you are continuing with the old regime of taxation and you are a salaried taxpayer, you will be getting the deduction of rupees 40,000 only, and the enhanced rupees 75,000 deduction will not be available to the to the individuals who are salaried taxpayers. I'll move to my next amendment. So it's related to the claim of TCS credit while the employer deduct TDS of their employees. Earlier, whenever the employer had to deduct TDS from the salary of their employees, they did not use to consider the TCS that had been collected from any payment that the employee had made. For example, if the employee had purchased a car, or there was some LRS. They had remitted certain funds under LRS scheme. TDS was being collected from those payments, but they were not getting the credit of that TCS while the employer was deducting TDS. So now to ease this burden and to provide better cash flow to the employees, it has been proposed that whenever the employer is making the computation of income of their employees, they will provide the credit of TCS as well. And also, if other TDS has already been deducted from the income of employees, they will provide benefit of that TDS as well. So this is something that government has provided a benefit so that the employee don't have to take refund at a later stage while filing their tax return. I'll move to my next amendment. So this is related to black money disclosure. This is something which is procedural, which was earlier there. It provides for penalty if you don't disclose certain kind of foreign income and assets in your return of income. So earlier there was a limit of rupees 5 lakhs if you don't show your foreign bank accounts or your assets in your return of income. Now this limit has been increased from rupees 5 lakhs to rupees 20 lakhs. So the penalty of rupees 10 lakh will apply in cases where the non-disclosure of rupees 20 lakh or more is not there. So this is something which is a relief for the taxpayers, because earlier whenever there was a misreporting or inaccurate reporting and that was in excess of rupees 5 lakhs, there was a straight penalty of rupees 10 lakhs that used to be levied on the taxpayers. So next we will discuss the capital gains provision. So if I have to sum up the amendments in capital gain, there are mainly two things. First one is that they have rationalized the period of holding with effect from 23rd of July 2024. Earlier, there were multiple period of holding prescribed for different kind of assets, ranging from 12 months to 36 months. For a different asset, there was 12 months prescribed. For a different class of asset, 24 months were prescribed. And for certain class of assets, it was 36 months also. So there were a lot of challenges, and it was very difficult to understand these provisions and also to understand which asset will qualify as short-term asset or a long-term asset. So now, with a view to provide certainty and rationalize the period of holding, there are two period of holding that has been prescribed now. One is related to any security that is listed on stock exchanges, and it is if it is a unit of unit trust of India, or it is equity oriented mutual funds, then the period of holding will be 12 months. If the period is lesser than 12 months, then it will be classified as short term capital asset. And if the period of holding is more than 12 months, it will be classified as long term capital asset. While in other cases, the period of holding has been rationalized at 24 months. If there is any asset, be it land or building, the period of holding is will be 24 months only. There was some exception earlier, but it has been rationalized now. So there are only two periods, 12 months and 36 months, that are that will be there post 23rd of July 2024. But while they have rationalized the period of holding for almost all the capital asset, 12 months and 24 months has been prescribed. They haven't mentioned about the slump sale. In slump sale, the capital gain is determined on the basis of the period of holding of the undertaking that the entity is selling. The period of holding has been determined at 36 months, but there is no corresponding amendment in the provisions of slump sale. So we can say that they haven't proposed any kind of change in the period of holding of slump sale. So if the undertaking is held for lesser than 36 months, it will still be classified as short-term capital. And if it is more than 36 months, then it will be classified as long-term capital. I mean, so if there is no amendment there that they haven't discussed, it will continue to be the same. Next is related to the mode of computation of capital gain. Earlier, the taxpayers used to get the benefit of indexation. So the indexation was introduced to cope up with the inflation that is prevalent in India, and this was being used for last many years. But now, since the government has reduced the tax rate from 20% to 12.5%, they have correspondingly removed the benefit of taxation. Any asset that is being sold after 23rd of July 2024, there will be no benefit of indexation. But if there is any asset which has been acquired before the 2001, they have granted further those capital assets. So you can take the fair market value of those assets as on 2001, and any property that has been purchased after that period, you will not be getting any kind of indexation benefits. So this is the benefit that they have removed, and there might be cases where taxpayers will find it difficult because there will be increase in their tax liability. So the next change that I will discuss is related to the tax on short-term capital gain. So the earlier the tax rate on short-term capital gain, which was derived from the sale of equity shares or mutual funds, it was capped at 15% only. But now this rate of tax has been increased from 15% to 20%. Any asset that you are selling on or after 23rd of July will be subjected to a higher tax rate. Earlier it was 15%, now it will be taxed at the rate of 20%. So this is something which is going to affect the taxpayers, and this will be a hardship for the taxpayers. So next is the rate of tax on long-term capital gains, and also the exemption limit that was there earlier. So the exemption limit has been increased from rupees 1 lakh to 1,25,000. So if an individual or any taxpayer has earned any capital gain which is long-term in nature, and it is up to a limit of rupees 1,25,000, or it is more than 1,25,000, then up to rupees 1,25,000, you won't have to pay any taxes on that particular amount. Earlier, it was capped at rupees 1 lakh. Now it has been increased from rupees 1 lakh to 1,25,000. Now we talk about the tax rate on long-term capital gain on sale of equity shares, mutual funds, and units of business trust. Earlier, the tax rate was at 10% only, but with this budget 2024, they have increased the tax rate from 10% to 12.5%. So this is something which will surely have impact on the tax liability of taxpayers. And both of the amendments, so this tax rate is effective from 23rd of July 2024. Any transaction that has been made after this particular date will be taxed at the rate of 12.5%, and earlier transactions will be taxed at 10% only. But this increased limit of rupees 1,25,000, this will be calculated for the whole financial year from 1st of April 2023 to 24 to 31st of March 2025. So these are the rates, the brief of rates that are applicable for a tax for a resident in for a taxpayer in India. For individuals and HUF, the tax rate is 12.5%, which was earlier 20%. For domestic companies, it will be 12.5% now, while earlier it was 20%. For non-resident or foreign company, when they sell when they sell an unlisted security, it is now at 12.5%. Earlier, it used to be 10%. And in all other cases, it has been proposed to be at the rate of 12.5%, while earlier it was 20%. And in case of other residents, the tax rate is now 12.5%, while earlier it was 20%. So now we will talk about the new TDS section that has been introduced to cover the payments which are made to the partners, which includes salary, remuneration, commission, bonus, and interest, or any payment that is made to the partners. Earlier, there was no TDS liability on firm's account while they make these kind of payments to the partners. But now there is an obligation on the firm that they need to deduct TDS at the rate of 10% on all the payments if the threshold of rupees 25,000 has been breaching. So there was no provision related to the TDS on these kind of payments. But now, since the government is taking some steps um, to rationalize every other provision and also to enhance the reporting mechanism, they have introduced this section to impose TDS on remuneration or any other payment made to the partners. So next is the I would say long due amendment that the industry was expecting. There is an amendment. There is a deduction that was available to the firms who make the payment of remuneration to the partners. Earlier, the limit of allowable remuneration was quite lower. So now that has been increased so that the allowance will be available. So the increased allowance will be available to the firms. So earlier, if the book profit is rupees 3 lakhs or the on the first 3 lakhs, the deduction of rupees 1,50,000 or at 90% of the book profit was allowed. Uh, the deduction of remuneration, and on the balance it was capped at 60%. But now, as per the proposed provisions, on the first rupees 6 lakhs, you will be getting the deduction of rupees 3 lakhs or 90% of the book profit. And on the rest, on the balance of the book profit, the deduction will be at 60%. So next, there is a clarificatory amendment in section 194C. There was a confusion between the taxpayers, or I would say that some of the taxpayers were deducting TDS under section 194J, while it was required to be deducted under section 194C, and vice versa. But now they have modified the definition of work, which says that if there is a deduction that is required to be made under section 194J, the no deduction will be made under section 194C. This amendment is applicable from 1st of October 2024. This is something which is a clarificatory amendment so that there is a certainty about the deduction of clear section. So next is the relaxation in prosecution proceedings. This is something which has been haunting the taxpayers, or I would say the honest taxpayers who made the tedious payment with a delay, but they did not had any malified intention. So now they have amended the provisions of 276B, which provides for prosecution, and it says that if you are found guilty, there will be imprisonment of 3 months to 7 years, and it will be with the fine also. But now a new proviso has been inserted, which says that if you have made the payment of TDS before the due date of filing of your TDS return, the prosecution proceedings will not be initiated against the taxpayers. But the thing is, if the TDS return is being filed with a delay, the due date for calculating the prosecution provisions will still be the due date for filing the TDS returns. It will not be a case where the TDS return has been delayed by 1 month, 2 months, or 3 months, and you will calculate that accordingly. But so that will not be the case. The due date will still be the original due date for filing the TDS return. Any payment made before that date will be considered, and no prosecution will be initiated. But if there is any payment that has been made after the filing of TDS, after the due date of TDS returns, then there will be chances that the prosecution proceedings will be initiated. So the next is the amendment in provisions of TDS related to assessee in default. Earlier, the timeline for making the TDS assessment was 7 years from passing of from was 7 years for making the assessee in default, and it was there was no provision which provided for any certainty in relation to the non-residents. So it was mentioned that the any person resident sorry, any person, it was mentioned that it will be applicable for a person resident in India. So for a person resident in India, earlier it was 7 years, but there was no mention of non-residents. So now they have amended the provisions, and the time limit of 7 years is applicable to both resident as well as the non-resident. So there will not be any case where there will not be any endless litigation, because earlier the courts have held that the time limit for these proceedings for the non-residents should be in line with the proceedings of reassessment. And also that 7 years has been reduced from 6 years. It has been done to reduce the litigation in India, because uh, the litigation doesn't stop in India. It goes on for an infinite period. And in case of TDS, they have 7 years to make the assessment. So this is something which is a good step that the government has taken. So the next amendment that I will be discussing is the time limit for revision of TDS returns. So earlier there was no time limit prescribed in the Income Tax Act, where you could revise your TDS returns for any period. But now they have implemented a time limit that after the expiry of 6 years from the end of the financial year in which you had filed your first return, you will not be able to make any correction, or you will not be able to file any correction statement, because the taxpayers used to revise their TDS return for 8 years, 9 years before also. So now this is something which is settled now, and no returns can be revised beyond 6 years. So the next we will talk about the reassessment proceedings. So earlier, the time limit for reopening the reassessment proceedings was 3 years in cases where the amount involved is rupees 50 lakhs is up to rupees 50 lakhs, and it was 10 years when the amount escaped was more than rupees 50 lakhs. And also there was no time limit which was prescribed under section 148A. So the procedure that was prescribed, it was that first of all, the AO will make inquiry under section 148A. They will provide the opportunity to the taxpayers, and after considering the reply from the taxpayer, they will pass their order under section 148AD. But 148A, there was no time limit that was prescribed, and it was assumed that the time limits for issuing the notice under section 148 for initiating the reassessment proceedings will be applicable to 148A also. Now they have prescribed the time limits for issuing the notice under section 148A also. So in cases where the amount that will be escaped, or that might be escaped, if it is up to rupees 50 lakhs, notice under section 148A can be issued within 3 years. And if the amount involved is more than rupees 50 lakhs, the time limit of 5 years will be applicable. And when they need to issue a notice under section 148A to reassess the income and to initiate the reassessment proceedings. So the time limit has been increased from 3 years to 3 years, 3 months, in case where the amount is less than 50 lakhs. And in case the amount is more than 50 lakhs, the time limit will be 5 years and 3 months. So the step that they have taken is to reduce the litigation in India, because I earlier mentioned that the litigation continues for long years, and there is no tax certainty in India. So this is a welcome step that the government has taken. And also earlier, when the notice under section 148 148 was issued, the taxpayers had to file a return of income with the corresponding and accurate details. And earlier, there was no time limit, I would say, because it was only the 3 months were mentioned there, and it also said that it could be further extended. So the section used to mention that 3 months or the extended time that the EU might allow. But now they cannot allow any further extension beyond 3 months, and the taxpayers need to file their tax return within 3 months only. Uh, so this is something was related to reassessment proceedings. Now the approval authority for sanctioning the notice under section 148 or 148A. Earlier there was a change in the sanctioning authority on the basis of if the timeline of 3 years is there, or timeline of more than 3 years is there. So the approval authorities used to change as per those timelines. Now they have provided this power to the lower authorities as well. Now, irrespective of the time limit and irrespective of the amount involved, the additional commissioner or the additional director, joint commissioner or the joint director, they can also sanction the notice under section 148 and 148A. So there's no need to go to the higher authorities for issuing these notices. So we have discussed the timelines. I'll move to my next slide. So Vivad se Vishwas scheme. So through Finance Act 2021, the government came up with a scheme, Vivad se Vishwas. The main intent of introducing this scheme was to reduce the litigation, was to reduce the penalties, so that the taxpayers come on their own, and where they want to settle or where they want to seek the peace of mind, they were provided with an option that they can come and offer a certain amount of income, or offer a certain amount of tax, that and they pay their taxes, and they will not be penalized. So it was quite a good success that this Vivad Se Vishwas scheme 1.0 was, and building on the success of that scheme, the government has now decided that they will relaunch this Vivad Se Vishwas scheme, where the rules are yet to be drafted, and the scheme will become effective sooner, and the rules for this entire scheme will be available. In our opinion, that this will be a great opportunity for the taxpayers who have long litigation, and they can take the benefit of this scheme and pay a certain amount, and they can uh, escape from the penal provisions also. So next is the angel tax. This was, I think, the most awaited by the industry, because earlier, whenever an unlisted company used to get certain amounts towards the share application money, and if this amount was in excess of the fair market value, the excess amount, the premium that the company used to receive, it was taxed in the hands of the company as their income from other sources. So this amendment was introduced through Finance Act 2012. The purpose of introducing this angel tax was that the unaccounted money. Uh, so there is a tick tap on the unaccounted money that the companies receive through share application money, and the scope of this section was introduced by Finance Act 2023. So earlier, the section was applicable only in cases where the companies receive this amount from resident shareholders. But through the amendment of Finance Act 2023, this was extended to the non-residents also. And this was highly criticized among the industry, and they were not happy that this provision was there. First of all, it was for resident, now it was extended to non-residents also, and it was creating quite hindrance for the companies, and also especially for the startups who were looking to obtain funding from Indians or from outside India also. So now the government has decided that the provisions of this section should not be applicable, considering that that the companies are finding it difficult to attract the investment in India. So the provisions of this section will no longer be applicable, and will not be applicable from assessment year 2025 to 2026. So next is the amendment in buyback provisions. While currently there is a provision which says that if a company is buying back their own shares, they need to pay additional tax of 20% under the provisions of section 115 QA of the act whenever they buy back their own shares. So the differential that they are paying to their shareholders, that will be the amount on which they will have to pay the 20% additional tax. And the income that the shareholders used to receive, that was exempt as dividend in their hands. I would not say properly the dividend word, but it was exempt under section 1034A. But now that the government says that it should be taxable in the hands of the shareholders only, and for that reason, this buyback tax has been abolished, and the company don't need to pay any tax on the buyback. So whatever amount that the shareholder will be receiving, that will be deemed as dividend income, and they will have to pay tax on that particular amount as dividend. A new section 222F has been introduced, and whatever amount that the shareholders receive, they will have to pay tax on that dividend amount. Also, the taxpayers will not be getting the benefit of cost of acquisition and any other expense that they might have incurred. So the cost of acquisition will be a capital loss for the taxpayers, which will be available to a taxpayer in the future years whenever they will sell their rest of the shares, or the rest of the assets that they will be selling. The cost of though so the consideration for the balance shares will be considered as nil, and the whole of the cost of acquisition will be available as capital loss, and the assessee will be able to set off that with their other capital gains. But in the year in which the shares are bought back, they will have to pay a tax on that amount as dividend. So this was the last slide and the last amendment that I was discussing. So that's it from now. So that's it from me, from the director's perspective. Thank you.
Yeah, Deepak, hope you seen the question in Q&A session and the chat box. So first address the question of the Q&A session, then we go in the chat box.
Sure, sure. I'll just look into those questions. So the first question that is from Shikhar, he's asking if there will be more cases where where the reference will be made to the valuation officer. So considering, in my opinion, if they have removed the benefit of indexation, the taxpayers will try to reduce the value at which they will be selling their properties. They will try that the amount that they are exchanging should be quite lower, considering the indexation benefit is not available. So they will try to do it at the circle rate, or even at the lower rates also. So in my opinion, there surely there will be more litigation, and because the people will be coming up with the new ideas, and there will be increase in reference to valuation officer, and this will surely lead to more litigation, and this is something which the government should have thought. So this was from Q&A. If I talk about the chat.
There is
So,
one
yeah,
says
so, yeah, please.
there is one question in the chat box is
Hmm.
where says also be applicable on sale of equity and STCG is applicable at 20%.
Uh, so if an Indian taxpayer is paying the taxes, cess is applicable. So if I talk about the competition mechanism, 20% is applicable on the capital gain that you're earning, and that will increased by the education cess.
Deepak,
Shikhar,
there's one more question from Mr. Deepak that he wants to understand the insight on since the rate has been reduced to 12.5% from 20%, the benefit of indexation has been withdrawn. So will this have an overall negative or positive impact on taxability of taxpayer? So if you would like to take this up
Mm.
with an example.
Yeah, so it depends on case to case basis. While this indexation benefit is not there, they have reduced the tax from 20% to 12.5%. So in cases where the property has been purchased recently, like 3 years, 2 years back, there might be cases that this new rate will be beneficial for the taxpayers, and that indexation might not be then that beneficial for them. And in cases where the property has been purchased 8 years or 10 years or maybe 15 years before, then I think the indexation would have been a better choice, considering the inflation in India and considering the rise of the uh, real estate rates in India. So this is something which is subjective and depends on case to case basis.
And whether 87A is still available? Another question from Mr.
So
Venkatesh.
87A is still available, irrespective of the regime. In case of old regime, it is capped at rupees 50,000, and if the taxpayer is opting for the new regime, it has been increased from 50,000 to 75,000.
I think these are all the questions that we have as of now in question answer box.
yes, these are the only questions we have, and we are also completed our session within the timeline. And thank you very much, Ankur sir and Deepak ji, for joining us and share your expertise with our participants and industry members. And thank you everyone to join us today. And we will see you in our next session on Monday on 5th, upcoming Monday on same time, 3 to 4 p.m. And we will share the detail of the session with you. And you can access our this event video if you miss anything. You can check on this on our website. We upload the session video on our website www.msme.in. Okay. Thank you. Good evening.
Thank you. Thank you, everyone.